Welcome to the Smarter Money Life podcast hosted by Andy Mattingly. Frequent guest on local TV news, regular segment on Indy Now TV, and a leader here at Forum Credit Union. Forum's mission is to help members lead their financial dreams, and in today's podcast, we're going to cover a topic that will help you improve your financial life. What can range from 300 to 850 is calculated and you don't even know it. It's not your IQ. It's actually your credit score. Hi, I'm Andy Mattingly, and today on the Smarter Money Life podcast, we're going to talk about credit scores and credit reports. And because I don't know everything about it, I've brought in Forum's resident guru, Chris Ferguson, who's going to answer a few important questions about credit scores and credit reports. Chris, thank you for joining us.
Honored to be here. Thanks for having me.
Good. And I'm not setting it up too much saying that you're the guru here, am I?
I hope not. I'll try to give my best and give my best advice.
Oh, you definitely will. So let's dive right in. The first thing I want to kind of ask or to explain to all of our audience is, what's the difference between a credit score and a credit report? Because sometimes we mix those two things together, but what's really the difference between those two things?
Yeah, absolutely. If you think about it, the credit report is really the foundation that the score is calculated off of. Credit report is really a history. It's a log of how you've used credit in the past. What have you borrowed in the past? How have you made your payments in the past? How much have you borrowed in the past? And how long have you borrowed things and so forth? And if you really think about it, it contains information not only on what you've borrowed, but can also contain information like judgments or tax liens or collections items. And so if you've had something come up in the past and you had to miss a utility payment or something like that, that can show up on a credit report. So it's all of those kind of logs of transactions and things that show how you've borrowed in past and debts that you've had in the past that a credit score is calculated off of.
So, one of the things that I've been told is that on your credit report, it also shows like all your previous addresses and any aliases or other names that you've used. Is that correct?
Yes, definitely. A credit report is used by lenders to kind of see what you've done in the past and to kind of gauge whether they're wanting to loan you a new debt or a new loan. But it can also be used to kind of verify identity at times. So your past credit or your past addresses, anywhere you've lived really in the last 7 to 10 years can show up on your credit report. If you had a past name, so if you've gone through a marriage and your former name can show up on your credit report, your date of birth, your social security number, it can be used to kind of verify age and other things like that as well.
So have you ever used an alias to get a loan, or do you have an alias that shows up on your credit report, Chris?
I have not. So no, I've always been Chris Ferguson.
Well, it might become Chris the Guru Ferguson now that we've started talking about that. So let's talk a little bit about what are some of the things that people do or have happen that can kind of bring their score down? Like what are the things they need to avoid to make sure that they can keep their score up?
Yeah, absolutely. If anyone asks, what can I do? What's the most important thing that I need to do? It's always just pay your bills on time, make your payments. So the number one thing that can bring your score up is actually having debts that you pay on time consistently over time. The number one thing that can bring your score down is doing the opposite of that. It's having debts and missing payments. And when we say missing payments, it's not a day late or 2 days late. I think the credit reporting agencies kind of built a little cushion there to say, they understand that, delays can happen in processing payments and maybe postage gets delayed. So if your payment is a day or two late, that's not going to really ding you. It's 30 days late that is what really hurts you. So having a payment that you miss by really more than a month, that is the most detrimental thing that you can do to impact your credit score.
Now, another thing that we've talked a little bit about in the past is like credit utilization. So basically all of my revolving charges. So if I have 7 or 8 credit cards, and let's say the limit is $10,000 between all of those credit cards. So I have a total limit of $10,000. How much should I have on those to get my credit score the best?
Yeah, a percentage to think of is 30%. And kind of to take a step back, one thing that I look at for credit utilization, a credit report and a credit score is kind of a gauge or a log to show how responsible you have managed your debts and how responsible you have used your ability to obtain debts and credit cards and so forth. And so if you have a credit card and you use all the funds that are available to you, that sometimes can be looked at as being a little bit irresponsible or a little bit reckless with your debt. So by having a credit card or having a credit or having a line of credit and utilizing less than 30% of what's available to you, it's kind of a sign that you're utilizing debt responsibly. You have it available there, but you're also leaving some funds available in case an emergency comes up that you can access if you need to. So if you have a credit card, and 30% means if you have a credit card with a $1,000 limit, if your balance exceeds $300, then you've exceeded 30% of your utilization basically there. So keep your balances under 30% of what's available to you to have the best score. If you do utilize more than 30%, it will lower your score. It's not as detrimental as missing a payment, but it will lower your score. And keeping your balances under 30% of what's available to you will ensure that you have the highest credit score available for that piece of or that component of the score calculation.
So would you say that let's say you're a younger person and you've had a $5,000 limit for a long time and you have to carry a little bit of debt on it. It might be helpful to you to just go ahead and open another credit card with a limit, even if you're not going to use it, just to get your utilization down, correct? I mean, it wouldn't be necessarily a bad thing to do that, or what do you think about that?
Yeah, absolutely. I don't always like to encourage people to just go out and get more credit cards and get more debts just for the sake of getting it. But if you have proven to yourself that you can have access to debt and you can manage that responsibly and you have a budget to ensure that you're not going to run up the balances on that new credit card that you get, then definitely either looking for I guess there's two things I would recommend. Looking at your current credit card. And if you've had a current credit card for more than a year and you are seeing a positive trend in your credit score and you have a good credit history, maybe reach out to that credit card company and request an increased limit. If you're younger, you're new to debt, you're probably starting off with a low limit, so maybe $1,000, $1,500. But after a year of having some consistent payment history, you're probably going to be given an opportunity to increase that slightly. And then the second thing would be to have a second credit card. Request another credit card. Having multiple items on your credit report is beneficial. If all you have is one item on your credit report, even if it has a high limit, you're really going to struggle sometimes of getting future loans and future debts from a lender because they don't only want to see a good credit score, but they want to see a good history on that credit report that we talked about earlier of multiple types of debts and multiple debts to kind of, again, go back to show that you've had access to credit in the past and you've managed that responsibly.
Yeah, and the other benefit of having a second card, we're all going to eventually have our card number stolen and fraud so that at least you can keep doing things while you get your card restored. So that's like another little benefit to throw into our audience. It's not always about credit scores that you do that. So let's talk about something else. So a lot of people, they have a lot of debt and they start paying things off, especially like credit cards. So should they close them? Because we know length of history is an important thing, or should they leave them open, just try to keep the balances off of them?
Yeah, so if you have an installment loan, so that is a loan that has a fixed end, a set number of payments, and once you make those agreed upon payments, that loan actually does get closed automatically for you once it's a zero balance. And so that means you had a debt that you paid on time, you paid it all the way to a zero balance, and it got closed. That's a great thing. But at some point, that item is no longer going to be on your credit, as time passes. So if you think about a credit card or a line of credit, they don't always have an end date. It's not like an installment loan, so they can stay open forever. And as we mentioned, you need to have something on your credit that's open and active in order to continue maintaining a quality credit score. So even if you don't plan on using a credit card, it's a good habit to just leave it open. You want to make sure that you're still monitoring it periodically and you're looking at statements that come through and make sure nobody has stolen that card number or doing something with it. But keeping that card, maybe locking it in a cabinet at your house, locking it in a fire safe or somewhere so that nobody can get it, and just leave it open, that can keep that open on your credit report and ensure that every month, even though you don't have a balance on it or maybe you're not using it, it's still reporting to the credit bureau agency as an open line of credit that you have available to you. It benefits that credit line utilization that we mentioned earlier of wanting to stay under 30% there, and it'll ensure that you have an active credit history that maintains that credit score.
Yeah. One thing that we've talked a lot about credit scores and credit reports and things, but we haven't really talked about like what makes a good score, like what is a good score. So I know that most scores that the people that are most familiar with is the FICO score. So we'll just kind of use that. kind of ranges from 300 to 850. So if you were telling someone, well, if you had a, let's just go good, better, best. What's a good score? What's a better score? And what would be the best score that you could achieve? I mean, not everyone's going to get an 850, so that's not the answer. But it's like, what's that good, better, best that you would recommend to people that should be their goals?
Yeah, I don't know that in my 20 years of at Forum Credit Union of looking at credit reports that I've ever seen a perfect 850 credit score. So it's something you can strive for, but don't be ashamed if you're not at 850. But at Forum, we have different tiers, and we consider anything above a 700 score as what we call our A score range. There is an A plus score range, so it gets better than that. But I really like to tell people, if you're above 700, you're doing something right. You have a couple items on your credit report. You probably haven't missed any payments. You've got a positive payment history. You probably don't have a lot of inquiries, which is something else that we can talk about that could impact your credit score. You're doing some good things there. If you fall below 700, it's probably a sign that you need to look at your credit report and understand what's there and what's holding you down and what are those negative impacts there. If you're in probably the 650 to 700 range, that probably means there's a couple small changes that you can make to make a big difference to get you back above that 700. But 700 is kind of a trigger there that I say if you want to have a target and if you want to have a number to look at and say, I want to strive to get somewhere and stay somewhere, keep your score above 700, and you'll typically be in a range where you'll get some of the best interest rates, or you'll have a best opportunity to get approved for future loans and debts when you need it in the future.
I always try to tell people that credit scores are like bowling. You want the highest score. It's not like golf. You're not going for the lowest score. So, you want to kind of do that. So now I want to talk a little bit about credit reports. And, one of the things that happens jokingly with some of the teammates here, we've talked about when they're looking for boyfriends, they should pull the credit report to see what it is to make sure it's not going to, cause them any issues. But in all seriousness, when you are getting ready to do something big in your life, and you're doing it with your significant other, either it's someone that you're married or it's just someone that you want to buy something with, a house or something, what do you suggest people do before they actually go and apply to make sure that there's not going to be any issues?
Yeah, there's a couple things. One of them is that you want to see a copy of your credit report. You want to know what's there. If you're entering into an agreement with someone else and you're going to be borrowing with them and applying for a mortgage or something else with someone else, you want to know kind of where they stand as well. So that's going to be your partner for the rest of the the next multi-years that you'll be in that debt together. But something else to think about is really planning. So a credit score and a quality credit report and a quality credit history is not something that you can get overnight. So if you do have plans, whether it's individually or with somebody else to buy a house in the near future, don't wait until you met with a realtor and you're going out shopping for homes to think about your credit and to think about where you stand and how you're going to pay for that house that you're looking for, or car, same way. Credit history, it can take many years to truly build and put you in a position to where you can get qualified for a mortgage to buy a house. So there's two things, really pull your credit report, find out where you are, but think about some of the things that we're sharing here today and really plan well in advance for that situation. Think about what's on your credit reports. Think about, what can you do as far as opening a credit card or getting an installment loan to have a good mix of credit. Review if there's anything negative on your credit report and pay that off and clean that up if you need to. Again, it takes a lot of time, and you plan well in advance.
What I'm also hear you saying is that you don't have to pull a credit report when you're starting to date someone to see if they're going to match up. So that's good. I think a lot of people wouldn't want to do that. The other thing that we haven't really talked about is what the impact of a poor credit score can do to you. And it's not about being able to get loans. It's even if you get a loan, a poor score can cost you, make the interest rate higher, things like that. So you want to dive into some of the things where people may not think about how their credit score impacts their financial life.
We talk a lot about, loans and debts and credit cards, as I've mentioned here, but credit scores can really impact you in a number of other ways as well. Insurance companies. If you go out and you're looking for auto insurance or homeowners insurance, a lot of times that insurance company is going to look at your credit score. They kind of see that as how risky are you in addition to how responsible you've used debt. And, insurance companies, they want to minimize their risk to maximize their profit. So if they see you as a risky person because you may have had some challenges in the past and that have lowered your credit score, they may not give you the highest or the best premiums, the lowest premiums, I should say, not highest. but then also rent. A lot of younger individuals who are maybe recent college graduates and they're kind of moving out and starting their own independent lives, they may be renting something for the first time. A lot of rental companies will pull your credit and look at a credit score. They also want to look at that and say, is that a gauge of how likely you are to make your monthly rent payment or not? If they see that you have a poor credit score, they may pass on you and deny your ability to rent an apartment or rent a home from them. So it's not just your ability to get a credit card and have good interest rates and so forth there. But that is something else is really interest rates. A lot of times people think of credit, it is borrowing and it is debts. That's kind of the foundation of credit there. So interest rates can be widely different based on credit score. So a credit score that's under 700, as we mentioned, that could give you an interest rate on a credit card that's up in the 25 to 30% or higher range on a credit card. But if you're well above that 700 range, you may be able to get an interest rate on a credit card that's, in today's environment, down around 12%, which is a huge difference from that 25, 30% range. So what that means ultimately is the amount of interest that you pay back to that lender or that credit card company. And that also leads into how long it takes you to pay off that balance. So if you have a quality credit score or you get a low interest rate, you may be able to pay off whatever balance is in, say, 12 months, for example. But that same balance at a 25 to 30% interest rate, that may take you 24 months to pay off. So there's a wide range of reasons and ways that a quality credit score and quality credit history can really benefit you financially and can make a huge difference in kind of your ability to have a financially stable lifestyle moving forward.
Yeah, and I think that you've made some good points there, and I think one of the biggest takeaways is a poor credit score just costs you more. It makes everything cost more because you're paying a higher interest, maybe you're paying more in insurance, maybe you don't get the rent that you want. But talking about rent, that does bring up something. Recently, a lot of the credit reporting agencies will take rent payments and put that on your report. And that's helpful because it allows lenders to see that you are making a payment and a commitment. And even though rent isn't a loan, it is showing that you're making a commitment.
Yes, I think of rent as a monthly housing expense.
Yeah.
And a monthly housing expense is also another term for a mortgage payment.
Yes.
And so if maybe you've not owned a home before and you're applying for a mortgage, if you can show history of paying a monthly housing expense month after month and a track record of that, that underwriter that's looking at your credit history and making a decision to approve you for that mortgage, they're going to look at that and they'll consider that. And that's going to be considered better than someone that has absolutely no history to prove that they've made a monthly housing payment in the past.
Yeah, very good, very good. Well, Chris, for our audience, do you have any last or parting shots? Because you are, as I've self-proclaimed you, the guru of credit scores and credit reports here at Forum Credit Union. Any final things you want to share?
I think just kind of remind everybody that it takes time to build a credit history. It takes time to build a quality credit score. It's not something that you can just go through life and it falls in your lap. You have to be proactive. You have to plan for it. You have to think about it and make strategic financial decisions to really put you in a good place to have a good history and good score. And if you do that, though, it can really make a huge difference later in life and give you the ability to, increase your savings because you're paying less on interest or, buy a house, buy a car. It can really make a huge impact in your financial lives and encourage everybody to kind of take it serious and be proactive at building your credit.
Well, thank you, Chris. I really appreciate you being our guest today on the podcast. This has been another episode of the Smarter Money Life podcast powered by Forum Credit Union. Please leave your thoughts in the comments and be sure to look for our next episode wherever you get your podcast. Remember, now is a great time to make a difference in your financial life. Until next time.